In our view, three things have changed. The first one is we've had a year of deceleration in 2018, and during the past quarter, this deceleration intensified, especially across DM markets, namely the US and the Eurozone. With that comes our second point, which is with slower growth, we also have lower inflation pressures. And not only lower oil prices, but also the fact that with this lower activity, this implies naturally a lower level of inflation pressures. Now, the combination of the two leads to the third point, which is the Fed acknowledged the fact that with this slowed economic momentum and lower inflation pressures, it did need to be that restrictive, so pushing markets to believe that they will moderate the pace at which they're going to increase rates. Across the past quarter, we've seen an increased pricing of recession risk across markets, with lower equities, higher credit spreads, higher bonds. Now, the question that we ask to ourselves is recession for now? Is the first quarter of 2019 going to be the entry of the world into a recession? We doubt it. We think that you need to make a difference between what's happening over the shorter run and over the longer run. Over the shorter run, valuation now look attractive, the Fed is on the side of investor a bit more, and we stand a good chance of seeing a better earnings season than expected. That for the shorter term end of the scenario. For the longer end, you need to reconsider the thing that recession risk is likely to increase across the year, not to decrease. And that is probably something that's going to drive both equities and bonds and increase the fact that sentiment that has been in the driver's seat over the past quarter is going to be very important across the year. We have three investment themes. The first one is with the increase in recession risk. We see the risk-return profile of both equities and credit to be deteriorating across the year. That's the first element. The second element is with this alignment of planets, having slower growth, lower inflation pressures, and the Fed stepping a bit out of its scenario. We think that opens the door to a bearish trend for the US dollar. Today we are bearish US dollar. The last element is for credit. We think that you need to be very discriminating when it comes to growth-related assets, and we don't really like credit. We think that credit failed to react much to the increase in the recession risk level, and usually credit is more forward-looking when it comes to this risk. So we really want to remain cautious with respect to this asset class.